What if the biggest market risk right now isn't Bitcoin, stocks, or inflation? What if it's simply the price of money? The US 30-year Treasury yield has climbed to 5.34%. And when the cost of borrowing stays this high, the effects don't stay in the bond market. They can spread through currencies, equities, and crypto. Welcome to Close Option Trading Desk. Today, we are looking at 4 developments traders should be watching closely: the US bond market, rising oil prices, the debt behind the AI boom, and Japan's changing role in global capital flows. Let's start with the bond market. US 30-year Treasury yields have climbed to 5.34%. That matters because the Treasury market sits at the center of global borrowing costs. The US government is borrowing heavily, while companies are also adding debt. At the same time, buyers are having to absorb a large amount of new supply. The Treasury is responding by increasing its debt buybacks in an effort to improve market liquidity. But higher yields create problems elsewhere. Mortgage rates can move higher. Highly leveraged businesses become more expensive to finance, and assets that depend heavily on cheap money, including some real estate and growth sectors, can become more vulnerable. For traders, the important point is that Treasury yields can influence markets far beyond bonds. Higher US yields can support the dollar, pressure rate-sensitive assets, and increase the cost of capital across the economy. So, watch the 30-year yield together with the dollar and risk assets. If yields continue moving higher while stocks and crypto weaken, that combination can be an important signal that financial conditions are tightening. The bond market is not the only source of pressure. Energy prices are becoming another major concern. Brent crude has moved above $90 a barrel, with prices reaching around $94 as Middle East supply risks increase. Higher oil prices can raise transportation costs, manufacturing costs, and eventually the price of everyday goods. That creates a difficult problem for central banks. They want to support economic growth, but if they cut interest rates too quickly while energy prices are rising, inflation could become difficult to control again. For forex traders, this matters because higher energy prices can change expectations for interest rates and affect currencies differently. For crypto traders, the bigger issue is liquidity. If renewed inflation keeps central banks cautious, expectations for easier monetary policy can weaken. So, don't watch crude oil in isolation. Compare oil with the dollar and Treasury yields. If all three are moving higher together, markets may be pricing in stronger inflation pressure and tighter financial conditions. Now, there is another source of pressure developing in technology, and this one is tied to debt. Major technology companies are expected to spend around $800 billion on AI infrastructure in 2026. At the same time, companies have issued nearly $1.7 trillion in corporate bonds this year. The concern is not simply that companies are spending too much on AI. The bigger question is whether revenue can grow fast enough to justify the amount of capital being committed. If credit markets become crowded while borrowing costs remain high, investors may become much more selective. That makes balance sheet strength increasingly important. Companies with strong free cash flow, large cash reserves, and manageable debt may be better positioned than companies that need aggressive borrowing to keep up with the AI race. For traders, this creates a simple filter. Don't judge a company only by its AI story. Look at its debt, cash flow, and ability to finance growth if borrowing costs remain high. And for the broader market, watch credit spreads. If corporate borrowing becomes noticeably more expensive, the pressure could eventually move from individual companies into equities and risk assets more broadly. Finally, we need to look at Japan, because what happens there can affect markets far beyond Tokyo. Japanese bond yields are rising, making domestic investments more attractive after decades of extremely low returns. That could encourage Japanese investors to move more capital back home instead of investing overseas. One market that could feel the impact is US Treasuries. If Japanese demand for US debt weakens, American borrowing costs could remain under pressure. At the same time, global liquidity could become tighter. This is particularly important for forex traders because changes in Japanese yields can affect the yen and global carry trades. It also matters for crypto because changes in global liquidity can influence the amount of capital available for higher risk assets. So, watch Japanese bond yields and the yen alongside US Treasury yields. A stronger yen combined with rising Japanese yields could signal that some capital is moving back toward Japan. Put these 4 developments together, and the picture becomes clearer. Higher borrowing costs, energy-driven inflation, massive AI spending, and changing global capital flows. For traders, That means the market may become less forgiving of excessive leverage and weak balance sheets. Watch the US 30-year yield, Brent crude, the dollar, the Japanese yen, and credit conditions as one connected picture. Subscribe and follow Close Option Trading Desk for more market analysis and trading-focused updates.